Like that. But thank you very much for all of you being here. Thank you to Mattos, Filho, and the Nasdaq for promoting this.
But nice to have all of you back here at Nasdaq. And I first went to Brazil in 2013, and from the time that I first went, and I was talking to Pedro earlier about this, we had no companies from Brazil. So Nasdaq didn't have any companies at all listed with us from Brazil. And we put in the time, the effort, the commitment to understand the entire community there, the ecosystem, bankers, lawyers, and certainly working with the different entrepreneurs and entrepreneurial groups, the venture capitalists who were building business. And successfully through over 5 years, because through 2017, we still had 0 companies. 2018, we listed our first company. And then today, we have 20 companies from Brazil, as well as some SPACs that are looking for targets in Brazil to list here on Nasdaq. So I would say that we now live, I thought when I joined Nasdaq that we were already living in the Nasdaq time. Kind of like the time when Nasdaq was hitting its inflection point, where companies really were going to understand the value of what we bring to a listing. But it took a lot longer than I thought, and certainly now we are living in the Nasdaq generation, and with so many technology companies, fintech companies, companies that are involved in decarbonization and changing the world that we know today necessarily through climate change issues that we have, we really find that we have embraced these type of companies and really help them to transition from private to public in a discernible way. And I think the fact that we have so many of the most sophisticated investors in the world, clearly the broadest, deepest, most liquid markets in the world here in the US, we will continue to see more and more companies from Brazil to be listed in the US and primarily listed here on Nasdaq. We actually do have 7 active public F1s. Our pipeline is fairly deep, though clearly the U.S. markets have not been receptive to any IPOs, let alone Brazilian IPOs, thus far this year. We certainly think that this is more of a delay than a stop of companies that will make the move from being a Brazilian company to being a public company listed here in the U.S.
Well, thank you very much for being here. I think Bob made the job very easy for me, but again, it's a pleasure to host all of you here at Nasdaq today. What are the investors are saying to them related to Brazil? You know, how are those conversations going, you know, in the last, few months?
What we're seeing is that we continue to see large, sophisticated investors like sovereign wealth funds and endowments very active and present in the country, kind of not rushing to increase their allocations and kind of waiting to see a little bit what's going to happen or what would be the outcome of the elections and what can eventually happen afterwards, how will be, let's say, new cabinet formed, who is going to be the president and so on. Differently from 4 years ago, in my opinion at least, the markets are not so, let's say, frozen. 4 years ago, the market was seeing like the elections on a kind of, let's say, binary outcome. Right now, let's say, the expected outcome shouldn't be so much different, but it is eventually kind of affecting what's happening on the public side. So after elections, maybe the market will pick up and we'll say, let's say, we'll give the confidence that Bob was saying also for increasing allocations in Brazil. On the private side, I think the decisions are, let's say, longer term. So there's not the option of investing and divesting, and so it's like a longer term decisions. In that sense, things are normal, I would say. Bob was saying that the first time he was in Brazil 13 years ago, even though you've been doing a great job bringing a lot of companies to the Nasdaq, and not only Vinci, but we also have a portfolio company called Vitru, which is also listed here in the Nasdaq. the reality is that in private markets, emerging markets as a whole has kind of been losing allocations, and the bulk of the capital that goes into emerging markets eventually have been going to mostly to China and secondly to India. I think Latin America as a region has kind of been losing attention from, let's say, global pension funds, global sovereign wealth funds that invest through directly. But it's kind of a stable in a way over the last 4 or 5 years. And if you look, Brazil has attracted about $1 billion per year if you add private equity, real estate, and infrastructure, which is a tiny amount of capital. I think the exception has really been on the venture capital side, that we saw a lot of activity, not only in Brazil but in Latin America over the last 4 or 5 years. And we'll see how, let's say, the market will catch up after this kind of pause that we're also seeing in venture capital right now. Having said that, I think a big hurdle that we all compete with is actually, in fact, the U.S. market, right? And if you look the returns more recently, and I think it's kind of a consequence of how the U.S. government decided to fight COVID, like pouring a lot of money into the economy, and that eventually led to very strong returns locally here in the U.S. In the private market side. So it's kind of the opportunity cost to take FX risk, political risk, country risk, made things harder. But I think the reality is that the amount of capital available in private markets in Brazil is so low that the returns are eventually strong, and the number of players active in the market also decreased over the last 10 years, if you look. So it provides a very, very compelling investing environment, right? So this will surface. The U.S. market will adjust as it is adjusting now. And I think Brazil, looking forward, and we can maybe debate on that also, I think is in a great position because if you look the China demographic trends, if you look 10 years, they're not so favorable. Brazil has at least another 2 decades of increasing working population. So it's like when you take long-term view for Brazil, I think we are in a really good place, obviously also in context with what's happening on the geopolitical side right now.
How you see future, how you see U.S. as a venue for listing Brazilian companies?
Until the last couple of years, the practice was been, or the approach was usually you'd have on a particular year, a significant Brazilian company listing in the U.S., and then a couple of years would pass before another U.S. listing, and you'd wait another couple of years. It isn't until recently, until the start of 2017, that if you looked at every single year since 2017, there has been a listing of a Brazilian company on a U.S. stock exchange, and in the majority of those cases, a primary listing in the U.S. where there hasn't been a Brazil listing. In preparing for this panel, I was sort of searching back to, or sort of Googling with regard to Brazilian companies listing in the U.S., and I came across an article in the New York Times in '98 saying, "Oh, Brazil companies, are now listing in the U.S." And the tone of that article, in part because as a result of Vale, as a result of Eletrobras, was that there was going to be a continued wave. That obviously didn't pan out, but I think it's different because the initial wave of Brazilian companies listing in the U.S. in the 90s was the result of privatizations. It was a finite number of companies looking to the U.S. market. I think one of the positive, one of the things that gives me hope in terms of this trend of every year having U.S. listed companies is, the fact that, 70, whatever number you said with regard to unicorns, at the end of the day, there needs to be sort of an exit strategy for a lot of these companies. But I think the last, 5 years, every year we've had a Brazilian company listed in the U.S., even though this year there hasn't been an IPO, there has been a listing via sort of de-SPACs, and so I think that trend continues. One other thing that's unique that's happened in the last, 12 or 18 months, and Bob mentioned Inter, is, existing sort of Brazilian public companies looking to sort of re-domicile themselves outside of Brazil and have a primary listing in the U.S., which is obviously very different than the traditional way to access the U.S. capital markets of the past, where the company would be listed in Brazil and then would add an ADR program. You don't see much of that going on in the last couple of years. I think in part, investors and companies have found that there isn't much liquidity when you have sort of dual listing and an ADR program. And you also have the issue that investors, particularly if you're in the tech space, there's this view, right or wrong, that you're still viewed as sort of a peer of other Brazil companies if you list ADRs, and it's a secondary sort of trading market as opposed to being listed in the U.S. as your primary market. And so you see a number of companies, sort of announcing that that are public in Brazil, announcing that they're contemplating sort of re-domiciling, whether it's Cayman or the UK or some other jurisdiction, to be able to list, to have their primary listing in the U.S. In part, they feel that way they'll have sort of access to a broader, group of sort of investor base, that people will compare them more to their peers as opposed to other Brazilian companies. We'll see, if that sort of trend continues. There have been, of the companies that have announced, and there have been 5 or 6 that publicly announced that they were looking to sort of move their listing from Brazil to the U.S. I think only one has done it, obviously because of the market conditions this year. But I think that's something that's also going to help companies continue to look to the U.S. market as an attractive market. So I'm hopeful that, unlike the past where it was sort of feast or famine, and there would just be one year where there were listings, and then you'd pass a couple years before a U.S. listing, that, particularly with the number of sort of venture capital-backed tech companies, that the sort of U.S. market just sort of makes sense to list as opposed to listing on the P3.
Because we built a business over these last 10 years that was far ahead of the curve in supplying this lithium for EV batteries. And our clients were all global. We were competing globally. And for 3 years, using the proceeds of that IPO, we've been mining and refining the high-purity lithium right there, selling these samples globally, competing globally, securing contracts globally. And we've been doing that in a different way than our global competitors, hence gaining share, 100% environmentally sustainable. So we became a key part of this energy transition, decarbonization thematic. Our clients were some of the largest EV battery makers in the world, namely LG, who has 2 JVs here in North America. They were going to be fed with the contracts with our material. In Asia, they have another factory in Korea, and then they have a factory in Europe. So we were supplying materials that would end up in the cars that everyone knew: VW, Tesla, GM, Fiat, Ferrari, Porsche, Audi, and we were sitting in a market that looked at us like a mining company. So our primary listing significantly undervalued the company. Pure play mining investors could not price this business, this integrated business machine we have, where we refined the pre-chemical, integrated with the feed of the mine. So at Nasdaq, we found our perfect home. What happened after we came here became a global phenomenon. U.S. investors who are experts in the EV supply chain because of Tesla were able to perfectly understand how significantly ahead we were and in the industry in sustainability, and put into the price of our product in their models that this could be a competitive advantage, which now it is. You see the emerging Atlantic supply chain. To this day, in this industry. We're still the only company that produces these materials in 100% sustainable manner. So to close it off, the quantitative results of being a Nasdaq for us, and we came from Canada, think about that. The demand for our shares significantly increased in the US because we had investors who understood our theme. But because we held on to the shares as private equity sponsors, so did our Canadian IPO investors. The share price went up 185% in a year compared to minus 9% of the Nasdaq. The liquidity is up 25 times.
For sure. But, talking about this, her company is so, focused on sustainability and the new, renewable energy. So here at Nasdaq, we have a very strong commitment to ESG. We've been investing since 2007 when we acquired all the Nordics exchange, just to have a very good view of sustainable companies. 2016, we found our Nasdaq Entrepreneurial Center to include and give education to entrepreneurship and diversity. And then 2016, we have also our Bond Sustainable Network, and just last year we just entered a partnership with Pedro, which is a carbon removal exchange. So we definitely know that every single corporate now has a key point on its strategy. I don't think any board today goes to any board meeting and don't talk about what they're doing in ESG and how they're going to report to the capital markets, because that's something that the investors are, asking to discuss.
I was the co-founder of the fund. We made this investment 6 years ago with the sole purpose, when again it was called Principle of Responsible Investment, as if there's such a thing as irresponsible investment, right? Which we thought it was the only way to go. And the purpose was to kind of look to a sector that was very, let's say, that had its social licenses skewed by society because it had a foot in mining, and try to do it differently, to demonstrate that those materials, which paradoxically were key to the energy transition, could be produced, embraced in society in an environmentally and socially sustainable way. So that was the mission. And we made a lot of hard decisions around it. So how did we start? We started with the G. Right? So the governance, because why the G? Because without strong governance, you can't execute. The governance drives this, especially as you grow. Governance defends it. They defend the trade-offs, because there are a lot of people who say that they like it, but when they see the trade-offs, they kind of dislike it quite quickly, because that was the environment where we implemented some of the worst trade-offs. 2018, 2017, it wasn't sexy. And it wasn't fashionable, it was hard. So that governance backed us fully. We've had BlackRock as an investor since IPO, and they were fully behind us, Janus, others, right? Then, listing here for the purpose of the G was kind of the culmination of that trajectory. So we started with the G. And then environmental sustainability, it was our obligation, because it was the reason why we had made the investment to begin with. So as we set out to develop this plant, again, we took an existing technology, we enhanced it, and we decided that we were going to make it green, that we would apply these clean tech technologies, enhance them, so that the processing of the material, where the magic works, where we take this ore that's like $80 a ton into $7,000 a ton ultra specialized pre-chemical product. That magic was going to be done differently, meaning without hazardous chemicals, without tailing dams, 100% reuse of waters, and then ultimately with green energy. And that was more expensive. It was 15% more expensive. And it was the first time in a Financial Times mining conference where someone came up with a number. It's 15% more capex, but it did not affect one iota in the overall returns, but somebody had to do it. So we did it in demo scale. So then this ahead of us gave us credit with the investors to go to the S. And then the pandemic came and sort of derailed it, because the social sustainability is a series of these connected actions designed to lift the people, and we had very ambitious plans based on very well-established economic principles. Economics is science. This isn't reinventing the wheel. We preserved, the purpose was preserve the resources, preserve the water, and lift the people. Now, lifting was adapted because it was initially based on development initiatives. With the pandemic, it was about making sure they were safe, so protect lives. So we supplied 36,000 tons of hospital disinfectors, 1,000 kilos of sanitizers. There were sanitizers in Narasuaí before Einstein, right? And then pandemic ended, or height of the pandemic, we moved to put a net to the population. So we enabled, to this day now, 2.4 million meals in a town of 50,000. So no hunger. We eradicated hunger. Fine. But then how you get them out of there? So it's the connectedness of the policies, right? So then, well, first, when the pandemic ended, reopened 2 child care centers so that the women could go back to work. And then now we're launching probably one of the most ambitious microcredit programs ever, in partnership with Mulheres do Brasil and Dona de Mim, where we start with 1,500 women. Again, in a town of 50,000, that's a good portion of it's basically 5% of the economically active female population. The goal is to get 10. So essentially, create this economic development massively by transforming ore at 80 to pre-chemicals at 7,000, but spreading the gains with society. And lastly, and that's what we're trying to do now in reinventing the way the business is taught, we integrated, so we're paying the royalties on the final product. So all that wealth is going to come into this town like oil and gas royalties. It's an enormous number, proportion to the budget, doubles the budget of the towns.
I just want to follow up on a point that Manuel said, but I think the question is more for Ivana. I think the possibility of having super voting share is something that attracts companies not only from Latin America and Brazil, but from all over the world to the Nasdaq. I wanted to know if you find that there is a change in heart of the investor base on that setup, or is still something that is well received by investors generally.
I think this rule was, was established a long time ago, especially with Google and Facebook. IPOs, Nasdaq was one of the big supporter of that. We don't see that, I think it's so common right now in the majority of companies. You have this great entrepreneur that started a company 10 years ago, and they grew at the point it is. So at the time of the IPO, they still want to make sure that they can, execute on the vision. So I think for many of those investors that, invest, they actually support some of that. So we haven't seen anything against it. Maybe on the side of the bank, so Manuel may have another type of view, but not from my side.
No, that's true. I think we're depending on when you're doing the IPO, in the market, you may get scrutiny in terms of, because what's standard for the super voting shares is that they automatically convert to regular Class A shares if if your economic interest falls below, let's say, 10%, or if you transfer to a third party, it converts automatically Class A shares. So if you look a couple years ago, I know WeWork had other issues, but one of the issues when they were trying to do the IPO was that they got a little bit aggressive in terms of those features, because at the end of the day, as Ivana mentioned, investors are fine. They're buying the vision of that founder, of that controlling shareholder, but they're not buying the vision of the controlling shareholder of someone who they don't know. And so the expectation is if that person is no longer holding the shares, they would expect those shares to convert. So there has been in the past, when people have been more aggressive and the market hasn't been that good, some pushback from investors with regard to the terms of the super voting, but not the super voting itself.